All right, let's dive into Alliance Resource Partners, or ARLP. Their Q4 2025 earnings report was a real head-scratcher. You see, the headline numbers told one story, but the way the market reacted? Well, that told a completely different one. So let's figure out what's really going on here. So right out of the gate, you've got this classic mixed bag. On one hand, ARLP absolutely crushed it on earnings per share, beat estimates by a solid 9 cents. That's great. But on the other hand, their revenue, it actually came in almost $20 million short of what everyone was expecting. So you have a beat on profit, but a miss on sales. What do you make of that? Usually that kind of thing sends some mixed signals.
But here's the kicker, the market wasn't confused one bit. In fact, the stock shot up over 3.5%. And get this, it did it on absolutely massive volume. We're talking more than 6 times the normal daily average. So the big question is, what on earth did traders see that made them hit the buy button so hard, even with that revenue miss?
Well, it's pretty clear that smart money was looking right past that headline revenue number. They saw something much, much more important going on underneath the surface. So let's peel back the layers and see what they saw.
See, the real story here has nothing to do with that small revenue miss. Nope. It's all about ARLP being an absolute cash-generating machine. It looks like the market decided that pure profitability and a rock-solid balance sheet were way more important. And honestly, when you see these numbers, you'll understand why. They're pretty staggering. First up, let's talk adjusted EBITDA. Now, that's just a fancy way of looking at a company's core profitability from its day-to-day operations. It came in at over $191 million. But here's the jaw-dropper. That's a 54% jump from the year before. I mean, wow, that is a massive signal that this company is running like a well-oiled machine. And all that profit? It's turning directly into cold, hard cash. Look at this number, a distribution coverage ratio of 1.29. Now, if you're an investor who cares about getting paid, this is huge. It basically means that for every dollar they promised to pay out to shareholders, they actually brought in $1.29. That extra 29 cents is a massive safety cushion. It tells you that their payout isn't just safe, it's very safe. So you might be asking, what are they doing with all that extra cash? Well, they're using it to build a fortress. Their total leverage ratio, which is just a measure of their debt, is only 0.66. To put that in perspective, that is incredibly low. In an environment with higher interest rates, having a balance sheet that strong is a massive, massive advantage. And it's exactly the kind of thing investors are looking for. And, this lines up perfectly with what the CEO, Joe Kraft, was saying. He talked about their solid performance and resilient coal generation. And it seems like the market was listening and totally bought into that story. They saw the operational strength and decided it was way more important than a simple revenue number. But it wasn't all sunshine and roses. There was a red flag. Okay, so for a balanced view, we absolutely have to talk about the risks. And the big one, the one that everyone was watching, was a pretty major issue at one of their key mines out in Appalachia. And management didn't beat around the bush. They came right out and said it. Production at their Mettiki mine is going to stop. It turns out a huge customer basically pulled their commitment, so the mine is set to shut down for good after March of 2026. Now, this wasn't a total shock to the market, but getting that final confirmation was definitely a negative. And we know this is for real, because the company has already sent out what are called WARN Act notices. That's a formal legal requirement here in the US before any big layoffs or plant closings. So yeah, this isn't a maybe, it's a definitely. Which brings us back to our big question. If a whole mine is shutting down, why in the world was the stock up? Well, this is where it gets really interesting, because management came to the table with a counter-argument that was so powerful it completely overshadowed the bad news about the Mettiki mine. They basically showed everyone that despite that one closure, the big picture for 2026 looks incredibly strong. And this chart right here, honestly, this might be the single most important slide of the entire presentation. Get this. As of their earnings call, more than 93% of all the coal they plan to sell in 2026 is already locked in. The contracts are signed and the prices are set. Think about that. It gives them this unbelievable visibility into their future revenue and profits. It basically takes all the guesswork, all the risk, right off the table for next year. And you can see that confidence reflected right in their full-year guidance. Look at these numbers. Even with an entire mine shutting down, they're still guiding for their total sales volume to go up year over year. That's incredible. They're also expecting really solid prices, and they've got their costs under control. So the message this sent to investors was crystal clear.
Yeah, the Mettiki thing isn't great, but it's a problem we can absolutely handle. And it's not just about their own execution. Management also pointed out some huge trends that are giving them a major tailwind. You've got this insatiable demand for electricity thanks to things like data centers and AI. At the same time, the domestic coal supply is getting tighter. And on top of that, a lot of utilities are pushing back the retirement dates for their old coal plants. All of this creates, well, it's almost a perfect setup for a company like Alliance.
Okay, so let's tie this all together and make our call. What's the bottom line here? What's the core investment thesis for ARLP moving forward? It really boils down to four key things. First off, the market got this one right. Cash flow is king, and ARLP is a cash flow powerhouse. Second, that Mettiki mine closure, it's a manageable, isolated issue, not a sign of a bigger problem. Third, and this is the big one, having over 93% of your next year already sold just removes so much risk. And finally, that incredible balance sheet gives them stability and a ton of options.
So when you add it all up, the powerful cash flow, the de-risked future, that pristine balance sheet, it paints a really compelling picture. That's why, based on this analysis, our official rating for Alliance Resource Partners is outperform.
So what does that mean going forward? Well, our thesis is pretty straightforward. The market is going to keep rewarding ARLP for its de-risked cash flow and that super strong balance sheet. We think that could push the shares up toward that $27 to $28 range over the next 6 months or so. Now, for a plausible surprise, a real wild card, what if they use that strong balance sheet to make a big, smart acquisition in the mineral space? That could be a huge new catalyst to unlock even more value. And just as a final reminder, this is not financial advice. Everything we've discussed today is purely for informational purposes. You should always do your own research before making any investment decisions.